Welcome back. It's time for us to now have a look at a problem so that we can see all the formulas and the concepts in action. I would recommend that before you watch the rest of this recording, take some time, take a screenshot of the problem and attempt it on your own based on what we would have covered in the previous recording. Having then done that, continue to watch this recording so that you can compare what is being done here with what you would have done. And that will help you to see where you might be falling short so that you can correct that particular misconception. All right, so let's have a look at the problem now. So we are told that the economy is in equilibrium and there's a national income of $400 billion. We're also given some marginal propensities. And one of the things that I recommend is as you look at a problem, try and see what information is provided by the problem, because this will give you an idea as to which formulas might be applicable in that particular case. So because we have obtained some marginal propensities, then remember that the marginal propensity for imports plus the marginal propensity for taxes plus the marginal propensity for savings plus the marginal propensity for consumption of domestic items is equal to 1. This implies that the marginal propensity for imports, the marginal propensity for taxes, plus the marginal propensity for savings is going to be equal to 1 minus the marginal propensity for consumption of domestic products. We were also told that in order to compute the multiplier, we could use K. And we can say that K is equal to 1 over 1 minus MPC, which is the same thing as saying that it can be 1 over MPM plus MPT plus MPS. All right, so we know that. Just for completeness, also remember that K can be defined as the change in Y over the change in J, where J are injections, which is the same thing as the change in Y. Remember, change in Y is the same thing as the change in national income over the change in W, which is the change in withdrawals. So given this piece of information that we have now, let's have a look at the problem. We're given the marginal propensity to consume domestic products at 0.7, to save at 0.15. So this is so in other words, we're saying that 70% out of the dollar goes towards consumption, 15% out of the dollar goes towards savings, 10% of the dollar goes towards paying taxes, and 5% of the dollar goes towards purchasing imports. So that's what we know. So we are told here that given the marginal propensities, let's calculate the value of the open economy multiplier. Now, key thing to bear in mind here is what is the distinction between an open economy, or let me put it here, an open economy versus a closed economy. Going back to our circular flow, we're saying that an open economy is one that does trade. So trade occurs with external partners. Now, in terms of closed, remember that the basic interplay takes place between households and firms. So we call that one sector. But we also realize that just looking at the basic model, it can be limited. So we might have to take governments into consideration. We might have to take financial institutions into consideration. And we might have to take our trading partners into considerations. So we could look at a closed system where we just look at households and firms without government intervention. Or we can look at a closed system where we look at household and firms with government intervention. So just to keep those in our minds as we go through the example. So we want to calculate the open economy multiplier. And if we're talking about the open economy, then it means that we need to account for imports, we need to account for taxes, and we also need to account for savings. Based on the information that we have been given here, then all of those have been accounted for. So therefore, in terms of computing K, then it's simply 1 over, well, what's the marginal propensity to consume? That's 0.7. So that's 0.7 plus the marginal propensity to save, that's 0.15 plus the marginal propensity to tax, that's 0.10 plus the marginal propensity to import goods and services, that's 0.05. That's all over 1. So this is equal to, and then we can now get our calculator and do our computations. So we have 0.7 plus 0.15 plus 0.10 plus 0.05. And I want you to note that that equates to 1. Oh, there's a mistake that I made here. Just sorry. It will equate to 1 because we are accounting for everything. But in the formula here, I should not have included the consumption. So let's get rid of that part. Sorry. It's this formula that we have derived up above. We are just looking at the injections. So let's go back again with the calculations. So it should be 0.15 plus 0.10 plus 0.05. And that gives us 0.3. So K is 1 over 0.3. And this is equal to 1 divided by 0.3. So that's equal to 3.33. So that's our multiplier. So let's just tag this so that we have this so that we can use it. So the multiplier is going to be the multiplier for the open economy. All right, now it's asking us in B to calculate the initial change in national income. And this initial change is going to result from the increase in government spending and investment. So just looking back at the problem, it tells us here that the government has introduced a new infrastructure program. And because of this, the government is going to increase spending by $10 billion. So in other words, the government is pumping some money into the economy because they want to create a better infrastructure for businesses to operate. It also tells us that firms, based on what is happening, they are saying that it would make sense for them to invest $5 billion. So based on these new infrastructure things that are happening, we are projecting that the future demand for goods and services is going to rise. And so based on that, if we look at the firm's intention within the society, we can approximate that they are going to invest about $5 billion into the economy. So therefore, if we are going to determine what the change in Y is, so we know that there's going to be some government spending, plus there's going to be some investments. Government spending is 10 billion, investment is 5 billion. So this tells us that there is a total of $15 billion, which are now coming into the pipeline. And this is coming into the pipeline as injections. Remember, these are not funds which are generated through factor income, but they are coming into the system. Therefore, they are going to be injections. And remember, we had said before that J is equal to what the government spend plus what is invested by firms plus the money that is coming in via exports. All right. So we have our injections. So this then is going to be the change in J. Now remember, we had a basic formula that says the change in injections is going to generate some change in national income, which is going to generate some changes in terms of investment. We have just computed, though, the multiplier, and the multiplier is 3.33. Therefore, stemming from this part of the formula, we know that the change in Y is going to be equal to some factor K times the change in injections. Well, we know what K is. K is, let me change color here. K is 3.33. We know that. And we want to multiply the change in injections by that factor by 3.33. Well, we know what the change in injections is because 15 billion was injected. So therefore, We have our 15 billion. And this will now give us the change in Y, or the change in national income. So it's 3.33 times 15, and that gives us 49.95. So we can just approximate that and call that $50 billion. So therefore, let us say that the change in national income is approximately $50 billion. So what this is telling us is that there was an initial injection of $15 billion. So initial injection of $15 billion. But this is going to create a demand of about $50 billion, or put it another way, it's going to raise the national income by about $50 billion, because we have to account for the multiplier effect. So over time, we are saying that this $15 billion is going to generate $50 billion worth of activity. All right, then it says we now need to calculate the induced investment. So let's drop that formula here. We know that induced investment is going to be equal to some factor. We call that factor V, times the change in demand. Now, if you look at the formula here, this formula gives us YT minus YT minus 1. So what it simply means is the current national income minus the previous national income, which is the same thing as being the change in Y. So the change in Y is YT minus YT minus 1. Let me just write that properly. So it is the same thing as YT minus YT minus 1. All right, so it's the same thing. Now, do we know what the change in Y is? Yes, we know what the change in Y is because we had computed it in our previous step. So the change in Y is $50 billion. Now, we are also given V. It is assumed in this example that V is 2. Therefore, we can compute the net induced investment. So IT is going to be equal to 2 times whatever the change in Y is, which is $50 billion. So therefore mean that IT is approximately $100 billion. In other words, let's just give some context. So we are saying here that the initial investment was $5 billion. That was the initial investment. However, when we account for the factor and how the change in national income is going to be realized, then we realize that we're now ending up with $100 billion. So in totality, we are saying that the total injections of $15 billion over time is going to generate $100 billion. 50 of that is going to be based on the increased national income. And also, I'm saying that 50 billion is going to be derived by the national income, but also in terms of investment, we are saying that $100 billion is then going to be invested inside of the system. So therefore, the total amount of economic activity is really going to be $150 billion in totality if we look at everything. Because there's going to be a 50 billion that is generated based on rising incomes. So that's national income. Plus, there's going to be some money that is going to be there based on investment. So there's going to be $100 billion worth of investment that is going to accrue over time, which far exceeds the initial of $5 billion that was placed into the system. All right, now it asks us to explain with reference to the calculation so the multiplier and accelerator can interact. Well, that's what I pretty much just explained in terms of going through the formula and showing the interaction between the change in injections, which drives the change in national income, which drives the change in investments. All right, so now in the final analysis, they are asking us that to do the analysis by looking at a closed environment without a government sector. And we're also told that the household, though, still has the same marginal propensity to consume domestic products. So if there is no, if the economy is closed, and we go back to our original set of propensities, if it is closed, then there's no MPM, because MPM must be equal to zero. In other words, we're not trading with anybody. Therefore, the exports is going to be, the import, sorry, is going to be zero. So MPM is going to be equal to zero. So we know that because we are assuming that we are now operating under a closed economy. Now we know that the household and the firms will have to interact. That is the basic or the core foundation of the circular model. But we're also told that governments are going to be there. So it means that financial institutions are not there. And we already decide that trade is not there. So those are not to be accounted for. So we accounted for household firms and government. Now, we are told here, there's no government sector. So if there's no government sector, then it means that the marginal propensity for taxes is also going to be zero. Oh, so let me put that. So that was my bad. So this is also going to be zero. So it therefore means that we can't account for the government either. So these two components are zero. Remember, we had MPM plus MPT plus MPS plus MPC is equal to 1. Now, if these two components are equal to 0, then it means that what we are left with is MPS, the propensity to save, plus the propensity to consume is equal to 1. So we can therefore simplify by simply looking at the marginal propensity to save plus the marginal propensity to consume, and we say that that is equal to 1. Now, we are told what the marginal propensity to consume is going to be. It is said that we are keeping it at 0.7. If we keep the marginal propensity to consume at 0.7, then remember, if we just rearrange the formulas, then we are going to get that the marginal propensity to save is going to be equal to 1 minus the marginal propensity to consume. So we'll know that. It therefore means that the marginal propensity to save is going to be 1 minus 0.7, which gives us 0.3. Remember to compute K can be computed as 1 over all of this stuff. Get a different color, yeah. All right. So here we go. This section, because remember we're dealing with injections. So this would be J, right? So therefore, because MPM is 0 and MPT is 0, it means that K is going to be equivalent to 1 over MPS. So we know that this is going to be equal to 1 over 0.3, which means that we will end up back with a 3.33. So in other words, what we're saying here is that based on the calculations that we have, the multiplier, for the open economy and for the closed economy under the conditions which have been stated are going to end up giving us back the same value or the same factor, which is 3.33. All right. And that pretty much rounds up our calculations. So please take some time and, go back through, see what I have done compared to what you would have done. And this wraps up Unit 3. In Unit 4, we are going to be looking at the concept of money, and that's what we are going to be doing next. Take care.